In this video, I would like to present the deposit credit expansion process in a different format than the T-account approach. You can see the T-account approach in textbooks or lecture notes. It shows you how the assets and the liabilities of the banks evolve during this process. Here, by looking at this process from a different perspective, I hope you can have a even better understanding about how this money goes through the banking system and the deposit split between the required reserve and the loans. Okay, let's start from talking about the assumptions. The first assumption is that the banks hold no excess reserve. That means the bank only hold money to satisfy the reserve requirement. Anything beyond that, if they have extra money, they want to lend out as loans so that they can receive interest income. The second assumption is that the public holds no cash. That means anybody in the economy, either individual or a firm, receive some money, they will make a deposit the whole amount into their checking account, into the banking system. They can also receive the money through a loan, and if they borrow the money, that means they want to use it. They have to pay it out to somebody else, and that somebody else will take the money to the bank and make a whole deposit, whole amount, and nothing left in their hands. Okay, the third assumption is the required reserve ratio is 10%. That just means for every $100 deposit to a bank, the bank need to take out $10, 10% of that $100 as the required reserve amount. Okay, they need to hold that $10 to meet the so-called liquidity demand, or say to meet the demand when any customer show up want to withdraw money from their checking accounts. Now, let's start the process from the Fed. Let's say the Fed want to increase money supply into the economy. They can do this by increase the so-called high-powered money or monetary base. It is achieved through a so-called open market operation. That means the Fed want to give, let's say, the banking system cash, $1,000, and then, of course, this bank, say the counterparty of this transaction is Bank A, they cannot receive the cash for nothing. They have to sell some assets to the Fed, that is usually in the form of T-bills, right? So in this transaction, the Fed purchased $1,000 T-bills from Bank A, and Bank A now received this $1,000 cash. For the Fed, it actually increased both the liability side and the asset side by $1,000 during this transaction. And that $1,000 just come out the Fed's safe. It was not on the Fed's balance sheet before this transaction. Only after this happens, the Fed create $1,000 liability and receive this $1,000 T-bills assets. Remember, the liability of the Fed in terms of money will be either the cash in public hands, which we assume is zero in this case, or it should be in reserve. So eventually, after this process completed, this $1,000 will become required reserve in the banking system. Okay, now let's go back to Bank A. Bank A received $1,000. If the Bank A does nothing with it, then it becomes $1,000 excess reserve. And of course, based on our assumption, Bank A want to lend it out as $1,000 loan to firm 1. Let's say that's firm 1 need money to pay the goods or services it purchased from firm 2. So it pays out this $1,000 to firm 2. Firm 2 take the money to Bank B to make a deposit of $1,000. Bank B look at this $1,000. Bank B knows it need to take out 10% of that. that is $100 to satisfy the reserve requirement, 10% of the $1,000, right? And then the rest, that is $900. Bank B don't want to hold excess reserve, don't want the $900 sit in the bank doing nothing. Bank B want to make out, take the rest of the $1,000 here, make out a loan to, say, firm 3. Firm 3 pays this $900 to firm 4, and firm 4, of course, take the money to its own bank, Bank C. And Bank C now have $900 more in deposits. Okay, and of course Bank C takes out $90, 10% of the $900 as the recorded reserve, and then the rest is $810. That will become a loan to somebody. Let's say that's firm 5. Of course, firm 5 use this loan to pay firm 6. Firm 6 take the money to Bank D, its own bank, right? Now at Bank D, the deposit increased by $810, and this $810 split between recorded reserve and the loans. The recorded reserve will be 10%, $81, and the loan size will be $729. Of course, this loan will become somebody else's deposit, right? And so the deposit, the next round will be deposit increased by $729, and of course that deposit will split between the recorded reserve and another loan. Okay, this is the process, and the process will go on and on and on. So eventually, let's look at its effect. Let's start from the deposit. Let me change the color here. Use a green color. The deposit initially at firm 2 increased by $1,000, and then at firm 4 that's $900, and then firm 6 deposit increased by $810. And of course, if the process goes on, it becomes this $729, and that loan goes to next round, become another deposit. Eventually, this deposit will increase by what? The deposit here increased by actually $10,000. You add all this 1,900, 810, 729, all this sequence of numbers up, you got $10,000. Okay, let's look at the loans. Let me change the color to red here. The initial loan is to firm 1, that's $1,000. Next loan to firm 3, $900, right? And then the third loan should be to firm 5, $810, and then next round we got another loan of $729. So for the loans, it also kind of increase and increase. The process keep going on. You got $10,000 more in loans. So you see, start from 1,000 and go through this expansion process. We got 10,000 in both deposit and the loans. How about the reserve? Let me change to another color. Let's look at blue. This initial reserve at Bank B actually is $100, and then at Bank C we have $90 more in reserve, and then at Bank D we have $81 more in reserve. Of course, here is the next round reserve, right? And this process going on and on, you will see eventually that's $1,000 reserve increase.